Hello and welcome to another trades and tutorials video. This video is going to be a little bit different than the ones I put up in the past. It's going to have a lot more information. It's going to be like a fire hose of information, and it's going to be a little bit longer than the typical 7 to 10 minutes. And I'll say it right up front, this is also going to include an invitation to a special boot camp that I'm doing for AM Trader and Day Trading Edge members next Tuesday. And the reason that I'm doing that is because of the chart you see here, and it is also because of the feedback I've been getting from the trade plan videos that I put out to our members. And I put out these trade plan videos every Monday, Tuesday, and Wednesday to 3 different trading services that we run. And the idea of these videos is to tell the member what the market's going to do next and which stocks to focus on based on the specific tactics and strategies that that particular service follows. But every single one of those benefits and starts from an understanding of which way the overall market is going to go. Is it going to be a major trend up? Are we going to be going sideways? Are we about to tank? And it also benefits from understanding how the intraday price action is going to work. And I do that and predict that based in a large part on what the opening range does. Now, I've given you in the trades and tutorials section here several videos over the last several months that talk about the opening range, and I'm going to continue that right here. But first, I have to start with this chart, which was also a trades and tutorials video. And this chart is one that came out, I think, as a market outlook at first. And what this chart tells you is this green histogram represents an aggregate of the 14 different ETFs that we track in our little big view section. And these 14 different sector ETFs are your standard sector ETFs. And the idea here is this represents the 6-month change in those ETFs. And it's just counting how many of those ETFs are positive versus negative. And as you can see, if I hadn't told you what this meant, it does a pretty good job of telling you when the market is vulnerable versus strong. It does an outstanding job of telling you when the market is vulnerable or strong when you combine it with this blue line here. Now we're looking at a weekly chart here simply so that we can see more data on the chart. This blue line is the 40-week moving average. So it's the same thing as the 200-day moving average. And the rule goes like this. If the market is below the 200-day moving average, you need to be cautious or negative. If you are also below the yellow line, which is 4 positive industry groups, when you are below the 200-day moving average, you are negative. You do not want to be long. And so this came up in an analysis, like I said, an earlier video, when we realized that if you go back and look, every time the market fell below the 200-day moving average or 40-week moving average, when the industry groups had a really high number, it tended to hold up pretty well. Okay, in this case, one of the rare cases, we actually fell below 4 and we didn't stay low for very long. Okay, but that is also because as soon as it started to move up, the number of industry groups moved up. But notice, as soon as you got back above that 200-day moving average and you had good industry group numbers, the market really took off. In this case, you broke below the 200-day and you didn't have good industry group numbers. In fact, they got worse and the market had a rough patch. Right? And then starting in 2013, we broke back above the 200-day moving average. We did so with good industry group support, and the market just took off. And every time it pulled back or even got close, there was great industry group support, and we had an amazing run. But then what happened? The market leveled out. And as the market leveled out, the industry group support started to crumble. And finally, and at this point, I was warning in these videos to our members, this thing is falling apart if we break the 200-day. This is not the 200-day retracement you want to buy. All right? Now, as it turns out, We broke the 200-day like a hot knife through butter and cascaded even lower, and industry group support fell apart. And ever since then, the market has really had a rough patch. Now, the last couple weeks, the market has started to rally, and look what's happened. All right, so this is point number one of this video. I made a big point out of the market crumbling or beginning to weaken back here. I want to make a big point right now that the industry groups are getting stronger. All right, now they have to continue to get stronger, but if we stay above the 200-day moving average in the SPYs or the 40-week moving average, however you want to watch it, and four or more industry groups, and now that we've already got five, let's see if we can get six and seven, see those industry groups build, then you can expect that this is a market that you want to look up on, not count it out. All right, don't expect it to roll over if the industry groups are strong. If the industry groups fall apart, then it's a different story. All right, so that takes me to a second point. Even though the industry groups are strengthening, we are not in the same market we were in 2013 and 14. All right, this market is divided. Many of the stocks that broke here are not coming back, or they're not going to come back for a long time. They're in longer term bear markets. All right, but at the same time, back in 2008, back here all the way to the left, when the market broke, look what happened. Industry group participation really crumbled for a long time, and the market retraced back to the 200. The industry groups did not come back, and then it rolled over. All right. Now, if we roll over like this, and the industry groups fall apart again, like I said, it's a different story. But until then, we are not in a 2008 market. All right. In fact, I would argue, but we'll see how it works out, that even if we roll over, we have to expect that we're going to find some support back here. All right. That said, we have a lot of stocks that are still going down, that are still struggling. All right. But now is the time, before the market looks great and breaks out, to be focusing on the emerging leaders. There are a lot of stocks that are emerging leaders. Now, when I say emerging leaders, in some ways I mean stocks that are just simply breaking out to new highs. All right, so just take a look at some of these stocks. These are stocks that we've been following. All right, so STZ, this thing is breaking out. This thing doesn't look anything like the overall market. All right, Nike, strong trend. Nvidia, and I picked stocks from different industry groups, so it's not all one industry group. Really strong. Now, earnings today, another impetus for me to say, you know what, it's time to do a boot camp. It's time to make sure everybody understands how this really works. Microsoft, huge gap up on earnings, and this is breaking out over a massive consolidation. Google, huge breakout. Now, granted, it looks extended, but what this is telling you is that the market is not falling apart like the media would have you believe, like the bears would have you believe. Amazon, strong again, and not only strong, but this has been strong all through 2015. Okay? McDonald's, all right, a stock that has been consolidating for years, now breaking out. Adobe, all right, now these are names you know. Facebook, strong. Home Depot. Look, these are all in different industry groups. They're all showing leadership. Now, granted, the number of new highs is still much lower than we'd like it to be. But by the time it gets clear and obvious, it's going to be too late. You will have missed some of the greatest opportunities. But even more important than that, now is not the time to be gloom and doom. Now is the time to control your risk and take advantage of the emerging markets and the emerging leaders. Not necessarily the emerging markets, but watch the emerging markets. All right. So here's an example. Here are some examples just from today or recent days of what I'm talking about. But first of all, another thing that really I guess inspired or got me to say I got to do this now is the last video that I put out in trades and tutorials. I looked at the what I call the market watch this way. And the reason for this is that 70% of a stock's move is driven by what the overall market does, right? I'm not making this up. This is the statistic that's been batted around for forever, for as long as I've known. And one of the best ways to be able to anticipate which way the overall market is going to go is to look at it through the lens of the opening range and do it with 4 different indexes all at once. So in the upper left hand, I've got the SPYs. In the upper right hand, I have the Qs. In the lower right hand, I have IWMs. In the lower left, I have the diamonds. All right, now I can't do a whole course on the opening range right now, right? But this is the essence of um, the video that I put out the other day, and it's really this simple. If you have a situation, and let's just go back to say yesterday. All right, so yesterday here was your opening range high and your opening range low. Now the opening range is, for the purposes of this demonstration right now, the first 30 minutes of the day. All right, now if I put that first 30 minutes of the day on each of the stocks, each of the indexes, you want to make sure that all the indexes that you're looking at are all going in the same direction relative to their opening range. And if you're trading above the opening range, it means the bulls are in control. If you're trading below the opening range, it means the bears are in control. All right, now, yesterday you had the SPYs break out and start to run. You had the diamonds break out and start to run. The Qs broke out. It didn't really run until about the middle of the day. And IWMs struggled, right? They broke out and they didn't really run. Now, the ones that were strong continued to go, but when IWMs, the weakest on a daily chart, broke down back into their opening range, the rest of the indexes also pulled back. Now, they were all over their opening range, so it wasn't a disaster, but it was a pullback, right? You want them all going in the same direction, and when one starts to fall apart, you got to be careful about what the other ones are doing. Okay, now today was a bit of a different day because you had Google gap higher, Microsoft gap higher, Amazon gap higher. But again, let's look at how the markets traded. Right? Initially, they gapped higher, put in an opening range high. Gapped higher, put in an opening range high. Okay. Gapped higher, put in an opening range high. And the fourth one, gapped higher and put in the opening range high. Now, if you were just watching the SPYs, you might think after the gap higher and the range, it starts to break down. Oh no, this thing is going to head lower. If you're watching the diamonds, you would think the same thing. However, if you were looking at the whole picture, you'd see a much different picture because you would see the Qs were holding up like a rock. They weren't breaking down. And while IWMs looked like they were breaking down, they were really only coming down from a higher level back down to their opening range low, and they didn't break down. So you shouldn't have been scared about the SPYs or the diamonds. And in fact, once they all started to turn back to the upside and back into their opening range, it was a mild, but it was a nice, even rally towards the end of the day. Okay, so when they were all going in the same direction, then you knew that that was the right direction. Right now, the video I did the other day on all this was actually a more dramatic day. I'll pull that up. I think it was on the 21st. Okay, so here's the 21st. Here's the quick synopsis of what I showed you the other day. So here's our opening range. on each one of the charts. Okay. Now, again, the important thing is where are the markets trading relative to their opening range. All right, so if we take the SPYs broke down, they happen to hold the previous day's low, and then they're trying to get back into their opening range. The Qs more of the same, broke down, trying to hold in their opening range. They're not breaking above the opening range, so the bulls aren't really in control. The diamonds, however, come all the way back through their opening range and actually make a new high, and they're looking bullish. Okay, so diamonds are looking bullish. The SPYs are having a hard time getting back to neutral. The Qs are maybe in neutral, but IWMs, again, the weakest of the four indexes on the daily chart as well, had broken down, never got even back into their opening range, and were sitting right next to their low of the day. So what does that tell you? That tells you when the IWMs, which are leading lower, start to break down to new lows of the day and pull the Qs back down under their opening range low and the SPYs under their opening range low, and then the Dow back into the opening range, that the market's in trouble and it's headed for a fall, and that's exactly what happened for the rest of the day. Okay, and in fact, they all closed after that on the lows of their day. Right now, all of this, as you can see, has to do with just a simple way of looking at the opening range. But the opening range is much more powerful than just this. The opening range, it can be used not just for 30 minutes, but for 5 minutes. And in fact, I'm going to show you a slide from a webinar that I typically do when I teach this in more detail. Okay, without getting into too much statistics or math, it's really a simple concept, which is that if you look at the first 30 minutes of the day, as I've said earlier, the high or the low of the day is actually determined in that first 30 minutes, an unusual amount of time. In fact, it's only 8% of the day, yet as much as almost 50% of the time, the high or the low will be determined in that period. So if you know that, and you know how to trade against that, it gives you a huge statistical edge. Now, if you break that down in terms of the high or the low of the day, it works out that 27% of the time it will be the low, and 23% of the time it will be the high of the day that is set in that first 30 minutes. Okay, but that's without doing anything special. If you take two more indicators and apply it to that basic concept, and one of those indicators is a determination that you are in a bull or a bear trend, it makes a dramatic impact. So in other words, when you're in a bullish trend as defined by an indicator, 62% of the time your opening range low will be the low of the day, and only 22% of the time the opening range high will be the high of the day. Now in a bearish trend, 39% of the time the high will be the high of the day, and the low of the first 30 minutes will be the low of the day. Now, so what does that mean? It means that if you're in a bullish trend, you want to believe in, trade off of that opening range low. If you're in a bearish trend, you want to expect the high to be set in the first 30 minutes. Now, this is just one trick, one application of knowing how to use the opening range properly. Having this indicator that determines whether you're in a bullish or bearish trend. There are several things that we look at the beginning of every day and actually before the market even opens to help determine whether or not we should expect that the high or the low of the day will happen in the first 30 minutes, whether it should be the high or whether it should be the low, right? Now, let me show you some examples of what I'm talking about with just stuff that has happened in the last day or two. All right, now again, this comes from just looking at the markets in the last day or two and realizing that, man, this is really the time that you absolutely have to be focused on what the opening range is doing, because it's just so powerful. All right, now let's just start with Facebook. Facebook broke out to new highs today, and then it sold off. It looked like Amazon, it looked like Google for a minute, except the gap wasn't as big. But look at the opening range low here. All right, now one of the things I've taught in other or in free webinars is how to identify the reversal pattern around the opening range low so that you're a buyer when it comes back into that opening range low. So you can catch moves that do this, that go from 101 to 102 and a half plus. Now, if you're a swing trader, you would do this because if you just bought it on the open, you'd have paid 102. But if you knew how to wait for it to pull back and do the U-turn, now you bought it at 101 and you're going home with $1 worth of profit. Maybe you took off half, and it's not as much of a risk taking it home with $1 profit. If you're a day trader, this was a great trade. But the question is, why this one? All right, why this one versus, say, a Home Depot, another great stock. All right, so Home Depot opened a little higher too, also opened up on new highs, but this thing didn't even pause at its opening range low or reverse. All right, so if you didn't know what you were doing around the opening range low here, it didn't do you much good, because if you were a buyer around 124.80, it sunk all the way to 123.20. So you can't just buy it because it's at the opening range low. You need to know that it's the right day. You need to know that it's the right pattern as a reversal so that you don't get caught being long when the market is bearish. All right, now here's another example of using the opening range, Adobe. Now, I bring up Adobe because just the other day I got an email from a customer who said, "Thank you very much, Jeff, for your training video or your trade plan video. I got into Adobe just like you suggested." And actually, what I had suggested was I pointed out Adobe on this day that it broke out, and I said, I wouldn't pay up for Adobe. I'd wait for it to pull back, and I'd wait until you can put $86 in your stop. Right now, this is the type of pattern that in a bull market you absolutely want to know about, because the pattern I'm referring to is a stock that's really strong and then it starts to pull back. And the question is, at what point do you jump in and expect the rally to start? Well, as I said, we have specific setups that we look for, levels that the market has to trade above in the prior day or days, along with an opening range breakout, to know that that's enough of a move to expect you'll get the explosive type move that we got yesterday. Now, for the trader who got into Adobe yesterday, for me, it was as simple as seeing it was a 5-minute opening range breakout. Here's my 5-minute opening range. So I'm not waiting for the 30-minute. In this case, it was a 5-minute that you wanted. All right, not just because it was moving up, but because it had also taken out another critical point that we look for on a pullback to know that 5 minutes is the one you need, and you can have a much tighter stop and have your stop at the low of the day and catch a nice move. And if you're a swing trader, be positioned to take it into the next day. And if you're a swing trader, all this thing has done now, it had a lousy day today, but it's still just right back to basically where you would have gotten in. Now, that's the value of knowing the right day to get in, because if you had gotten in on any other day after the breakout, you'd almost be underwater on almost any other one of them, unless you're just buying the down day. Okay, now Adobe actually stopped today right where we would have expected it to stop. So tomorrow, I don't know what's going to happen tomorrow, but tomorrow is a good day to be looking to buy Adobe for the resumption. Although Adobe has a tendency to be weak for a couple days and then take off. Okay, so if it's weak again, we'll just wait, and as long as it doesn't break the key level that we look at to determine that the short-term bull move has rolled over, then we'll continue to probe it. All right, but all this is based on knowing several key points to look for and then knowing where the opening range lines up with those points. Now, today was a really bullish day, but I was also watching a couple of shorts. And this one, admittedly, I was watching yesterday and it didn't work out as well, but I stuck with it. Okay. Now, I was watching it yesterday, and this too is one that I pointed out to our members earlier in the week, and I was watching it. So yesterday, it was a day to be short through the 30-minute opening range low, which was right here. And that's exactly what I did. Now, as it turned out, it didn't really work out. I wound up taking a small loss on it because I didn't want to take it home without a profit. But today, 5-minute opening range breakdown right through here, it was, I don't want to say a give me because it's never, nothing's ever for certain, but that's exactly what I was looking for. I didn't need to wait for the 30-minute opening range on this one. And even though the market was having a great day, this thing just fell out of bed. All right, now this has everything to do with combining what's going on with a bigger picture and identifying that this is the day that this bearish trend, and this is what I was referring to when I said some stocks are just broken. This is one that just looks broken, it's acting broken, and it's going to have plenty of up days, but on the days that it starts to turn, you'll know exactly when it's time to jump on it on the short side or on the long side. But you have to know whether you want a 5-minute opening range, whether you want a 30-minute opening range, whether you want to buy a opening range reversal against the lows, or short and opening range reversal against the highs. So today there was another good example of that in Williams Sonoma. Now, Williams Sonoma, as you can see, another one that has just been getting hit pretty hard, and another one that I missed yesterday. This was this one and Dollar General that I was focused on the short, and I just missed this opening range breakdown right here. Right, but you can see how beautifully it worked, and I had to watch it go down. But today, look what happened. Today, it was a strong market, and Williams Sonoma, while it didn't gap up, tried to go up with the market, but here's your opening range high. Now, I've pointed out buying against the opening range low. Here's an example of selling against the opening range high. Right? Same idea, just in reverse. And just like with buying against the opening range low, like I said in Facebook, what you look for is stocks that if they come back down to the opening range low are more likely to break it and continue to go lower. All right. Again, this has everything to do with knowing which opening range strategy to apply when, based on several basic patterns, many of which you know even before the market opens. In fact, the videos that I put out for members are all put out before the market opens, and I'm able to tell them where I would look for opening range reversals, either long or short, or breakouts, 5 minutes or 30 minutes. And then all you have to do is wait to see where that opening range sets up the next day. So finally, one last stock because everybody likes it, Apple. Apple was another example of, it was kind of like the Adobe. It hasn't pulled back, but it has a pattern that suggested that today was a day not to wait for a 30-minute opening range breakout, but instead a 5-minute opening range. All right. So 5-minute opening range breakout is right here at 117. If you'd waited for the 30-minute opening range, yeah, you would have done okay, but that's not the right play for the setup that occurred. All right, not just because it went up, but because the risk you take when it's up here just is not nearly as good as it is down here. But you don't want to just take every 5-minute opening range breakout because they fail a lot more often than the 30-minute ones do, especially if you put your stop below the low of the day. All right, so I think you can see the value both from a day trader understanding that today would be the day for a 5-minute opening range breakout in Apple, because I'd much rather be a buyer at 117 and change on a stock that's going up to 119 than a buyer at 118.50. Right now, even as a swing trader, getting in that early, that means you've got either your opportunity to take some profits before you even take your position home, or you're sitting on a bigger cushion, or even in my case, partly in my case, I was long based on the reversal here, and I knew not to get out. All right, I had a good stop, and I was able to just let it run. And again, I used the opening ranges to not only get me into trades, but to get me out of trades. So they help me stay in trades longer. They help me lock in profits tighter. And it doesn't matter whether I'm day trading or I'm swing trading, they're an integral part of maximizing my profits and increasing the percent of winners. So this is why I've decided, and I did this for other services that we have, other members. Every once in a while, I just decide I'm going to do a special training session. Everybody who's a member gets it for free. It's like a big refresher course. We go over all the key points of what they should know for that strategy. We go over current stock setups. It's almost like the whole course summarized and done over. And I decided this was absolutely the time to do it. And I really thought I should do it on Monday, but unfortunately, I couldn't get the word out until late today, late Friday, that is. And so I had to push it to Tuesday. And so as soon as I pushed it to Tuesday, I thought, you know what, I'll open this up to anyone else who wants to join us. But you do need to become a member of AM Trader. And I'll tell you what that is in a second. So, and I can only take 25 new people, because really I am doing this for the members. It's open to anybody, can ask questions as well. So I want anybody who comes to be able to ask as many questions as they want, but we can't be overloaded with people who are new. So this is better for everybody who gets in. It's better for everybody who is already a member. And for those of you who don't act quickly enough, well, then I'm sorry. So I'm going to open this up until Sunday night. Sunday night we'll close it. It'll actually happen Tuesday, October 27th, right after the market closes. It'll be 90 minutes. Like I said, it's going to be live training that will accelerate and perfect your trading skills. And I should have put based on using the opening range and how the opening range is set up with other specific indicators and patterns. There aren't a lot of them, but there's definitely what we call the roadmap, right? So every day I know exactly where an opening range breakout should be followed and where it should be ignored, and where a breakdown should be followed and where it should be ignored, and where the reversals should be followed and where they should be ignored. And it's all based on a few simple rules, and those simple rules are exactly what we're going to focus on. Okay, so that's how you're able to identify the best daily charts to trade each day for lowest risk and the biggest gains. All right. Now, as I said, in order to participate in this, you do need to be a member of the AM Trader. Now, the AM Trader is actually a streaming video course that has 3 modules that teach you all about the opening range. So the opening range, the module 1 teaches you everything you need to know about the opening range, where you should look for it to be bullish, where you should look for it to be bearish. And then we go into the different trades that you'll do off of it. The opening range reversal, when you're either buying at the low or selling at the high. And then we'll go into the quick AM breakout, which is that breakout right off of a gap or right off of the first 5 minutes in the morning, or when you should wait for the 30-minute opening range. So this enables you to trade gaps, trade those quick pops like Apple today, as I demonstrated, like DG on the downside, and also it helps you to avoid getting caught in fake breakouts, right? If you're not using the opening range to help you determine when to get in, it's really easy to get sucked into those breakouts that just fail. So all of that's covered in the streaming course, and all of this is going to be covered in an accelerated way in the bonus session or the boot camp session. Now, in addition, right now when you buy and become a member of the AM Trader, you also get a year of mentoring, which we call Day Trading Edge mentoring. This is that weekly trade plan video I put out. For you guys, I put it out every Wednesday. So you'll have the training on Tuesday, and then Wednesday you'll get a fresh video. But Tuesday it's going to be like getting a video as well. So next week will be packed with ideas, analysis, and mentoring for everybody who's a part of this, which perfect week to do it because it's a huge earnings week. And as I've already said, so many stocks are really beginning to blossom and show huge potential. So this is an outstanding time to get started with any kind of trading where you can catch momentum. So you'll get that weekly trade plan video every Wednesday night. You'll also get a daily focus list every single day, and these are the stocks that we focus on for these particular strategies and approaches. Again, you could be swing trading, you could be day trading. The only difference is how long you're going to hold the trades that you're trying to get into. So these two things together, the AM Trader course itself, as I said, a streaming video, you get that for lifetime access, and as you can see, we add materials to it. So when we get done with this bonus session, everybody who bought this course last year or 2 years ago, I'm inviting them to come to this. They're getting this for absolutely free. All right, so if I do this in the future, you'll get the next one for free. All right, now the Day Trading Edge mentoring program is a subscription. It's usually $97 a month. So that's how we get $1,164 in value. You're going to get a free year of that at basically as a bonus. Another bonus that that's currently part of signing up for AM Trader is 20 training videos. I'm not going to go into that in detail right now, but it's basically extra videos that I've done over the years to help you see and use the opening range with other indicators, different setups, and just different nuances in how to see it. All right, now that's a $200 value. The third bonus, or I should say the second bonus, is the 83% Traders Advantage. Now we're going to go over this also in the live boot camp, but basically, as I pointed out, there are 3 indicators that you want to put together that will take your percentage of knowing when the opening range low is going to be the low of the day from 27% to 62%. It'll take you from knowing when the opening range high is going to be the high of the day from 23% to 39%. Now, even just 23 and 27% gives you a huge edge, but to know that 62% and 39% is enormous. All right, so it's not hard, and not only that, you can know it before the market even opens. And then, of course, the last bonus is the boot camp session itself. Of course, it will be recorded, and you'll be able to watch it over and over. So if you can't make it live, you can get the recording, but you do need to get in before Sunday night, and you need to be one of the first 25 to get in. And all of this would be a $1,958 value, not even including the boot camp. I didn't even put a value on that, which could easily, I could put a value of $400 on that because it's going to be equivalent to an accelerated course. But all this is going to be one payment of $497. All right. You need to go to this special URL, marketgauge.com/bootcamp. All right, there you will see probably this video. I'll probably put this video on the page as well, and an ability to see a detailed outline of everything that I just ran through quickly and be able to become a member. Once you become a member, you'll be able to immediately log in and see past videos and see the AM Trader course. So that's it. The key here is, as I started the video with, the markets are turning up. If they continue to turn up, they are turning up in a way that is consistent with the beginning of a new move. If they roll over, you will see it coming. I'm going to do a market outlook video, which is a free video we put out every week. I will talk about the one indicator I think you need to be focused on right now to determine whether or not you should continue to expect the market to move higher or look for it to move lower. It's all going to be based on something as simple as the 200-day moving average. So my point is, don't be afraid to be bullish when you know right below you there's an easy way to determine it's time to stop being bullish so you don't get hurt. The worst thing you can do is nothing. All right, so if you're doing fine and this volatility is working for you and the trends that are existing are there and you're catching them, then don't let me change what you're doing. But if you need help, this is a way that you can change the way you see how markets operate, and you can apply it to so many different ways. As I said, this is something that's applicable to 3 different groups of traders that we coach and mentor with different strategies. So I'm sure, because of that and because of feedback that I've gotten from other traders who have taken this course, who have adopted the opening range methodology as one of the ways they've looked at the markets and said, this is now an integral part of how I see the markets. Thank you, thank you, thank you. So marketgauge.com/bootcamp before Sunday night. Get in, and I hope I see you Tuesday. And if you've got any questions, leave them in the chat window. It gets converted to an email over the weekend. It's hard to be too responsive or immediately responsive, but we will respond by Monday. And if you let me know you're interested in this space, we won't lock you out. Have a great weekend. Hope you're doing well, and look forward to better markets ahead.